This is Matthew Cratter from Treasury University, and today I want to talk about something very important that may be about to happen. This is Janet Yellen's plan to destroy stocks. She's actually trying to save stocks, but I think it's going to have the opposite effect, unfortunately. So for those of you who don't know, Janet Yellen used to be the chair of the Federal Reserve, which is a central bank in the U.S., and then she went on under Biden to serve as a secretary of the Treasury since early 2021. So that's Janet Yellen. We just have to kind of review the actors here. U.S. dollar index, also known as DXY or DXY, it's a basket of currencies, and it's used as a way of measuring the relative strength or weakness of the U.S. dollar against these other major currencies. So against the euro, the yen, pound sterling, Canadian dollar, Swedish krona, and Swiss franc. It's mostly the components that influence the basket the most are the euro, which is about 58% weighting, and the yen, which is about 14% weighting. So we have Janet Yellen, we have the US dollar index, the DXY, and we have Harald Malmgren. He is a very smart guy. He studied physics as an undergrad, and he was a senior aide to John F. Kennedy, to JFK, to Lyndon B. Johnson, to Nixon, to Ford, and he's a very connected Washington insider who's now in his, I want to say he's in his 80s now. But when he tweets, you definitely need to pay attention. And so this is what we're going to be talking about today. A tweet from Malmgren from a couple days ago that I just came across my desk. This is the tweet. Yes, Albert has that right. Treasury quietly, so it's the U.S. Treasury and Yellen, quietly aiming at dollar index to 110 plus by summer. So this is saying that Yellen wants to push the DXY up to 110 and beyond by the summer of 2022, hoping world's biggest asset managers will ramp up U.S. stock purchases to assist avoidance of U.S. equities crash. With DXY at 110 plus, where else could they go? And he was discussing this with another account, Live Monitor, a guy named Albert Marco, I believe it is, talking about this target. Albert Marco says the plan is to force capital into U.S. equities while also hitting inflation in commodities at the same time. She did the same thing in 2012 to 2013. So what might be going on here? Well, we have Yellen saying just a few days ago, saying that the aim is maximum pain for Russia without hurting the U.S. economy. So how does a higher DXY do this? Well, if you force the U.S. dollar higher against all the other global currencies, this has the tendency to weaken oil prices, simply because oil prices are denominated in U.S. dollars for the most part now. If you weaken oil prices, you help out the current administration during the upcoming November midterms. It makes grocery prices lower because of transportation costs. It lowers prices at the gas pumps. And it also will have the effect of hurting Putin and the funding of his war machine, which is mostly funded by energy prices, natural gas and crude oil. And all else being equal, if you force the dollar to strengthen, it makes commodity prices, which are all denominated in dollars, for the most part, it drives them lower. If the US dollar keeps marching higher, as it has been for 2022, foreign central banks will also have a good reason to hold on to their US denominated assets, like US treasuries, which the US government desperately needs people to buy and hold, and also US stocks. At least this is what Yellen believes. I believe it's going to have the exact opposite effect and continue to tank the stock market. But this idea is, why would you try to get out of the US dollar today if you know that it will be strengthening against your local currency in the coming months? And we've been seeing this, especially US dollar strengthening against the euro and against the yen, driving up the DXY, driving up the DXY. We can see here that we're at multi-year highs, testing the 104 level, and this is what Yellen wants to push up to 110. So how do you do this? If you're Janet Yellen and the U.S. Treasury, how do you push the DXY up to 110? How do you encourage the U.S. dollar to strengthen against other foreign currencies? Well, the easiest way is to apply pressure to the Fed to keep raising interest rates. Of course, the U.S. Treasury and the Fed are always working together. There's supposed to be this independence, but there's not. And they do coordinated things to revalue the dollar, to devalue the dollar, to push interest rates and push FX rates around. This is made possible, of course, by the fact that Janet Yellen used to be the head of the Fed, and now she's the head of the Treasury. So these people, it's a revolving door of parasites and rent seekers. But she certainly has the connections and the power to apply pressure to Jerome Powell, who seems to be fairly weak anyway, to keep raising interest rates, and also to signal that more interest rate hikes are coming. In other words, jawboning the Fed funds futures higher, jawboning Eurodollar rates higher. And this has the effect of strengthening the US dollar, because people like to be in a currency that has higher interest rates versus a currency that has lower interest rates. So one of the ways to strengthen your currency is by raising interest rates. It might not last, it might not work forever, but it can have a good short-term effect. And then the third way to drive the Dixie up to 110 is to continue this policy of quantitative tightening, which has just begun with the Fed shrinking their balance sheet. Now, unfortunately, we know what happens when the Fed raises interest rates, when it starts to shrink its balance sheet, and when it signals more hawkish guidance ahead, it means weaker equity markets. This is one of the main lessons. If you hadn't known this, you've certainly learned it in 2022 with everything crashing, even US bonds crashing, US Treasuries crashing, everything going down except maybe the VIX and the Dixie both going up as the US dollar strengthens. So if you push the Dixie up to 110, yes, this will help to bring down crude oil prices and other commodity prices, which will be good for a good way of fighting inflation. But unfortunately, it's going to have the opposite effect on global stock markets and on especially on developing markets, on emerging markets, but also on the U.S. stock market. U.S. stock market, the U.S. economy cannot tolerate higher rates or a stronger U.S. dollar simply because there's so much leverage in the system. We've talked about this many times, how debt to GDP levels are much higher than they have been in decades. And so it's very difficult when you start raising rates, things start to blow up, as we've been seeing in 2022. A strong U.S. dollar also hurts U.S. listed multinational companies. In other words, stocks that trade on the New York Stock Exchange or the NASDAQ, they're listed in the U.S., even though their headquarters might not be in the U.S., though they mostly are in the U.S. And what happens is a lot of these companies have the majority of their revenues come from overseas. They're denominated in foreign currencies, which are then converted back into U.S. dollars. And this hurts earnings when you have a strong U.S. dollar and you're having all these foreign earnings that need to be converted back into dollars. So a Dixie at 110 means that the stock market crash will continue. We saw the Dixie rise in early 2020 as the pandemic was getting started and as definitely causing stocks to crash and treasuries to crash. So I don't understand why Yellen thinks this is a way of propping up the U.S. stock market. It's certainly a way of indirectly hurting Putin and driving oil prices down, at least temporarily. But this is going to be very, very bad for the U.S. stock market if Janet Yellen has her way. Now, you might be asking at this point, can Yellen really be this dumb? Well, I'm not sure she's dumb, but she has a terrible track record for predicting things. So back in 2017, back when she was still head of the Fed, chair of the Fed, she said that quantitative tightening, shrinking the Fed's balance sheet, was going to be like watching paint dry. Instead, we ended up with a whole repo crisis. We ended up with a mini stock market crash. She was certainly wrong about that. And she was also wrong when she said that she expects no new financial crisis in our lifetimes. It's hard to believe that she would believe something like this simply because the baby boomers' retirement and the strains on the system as all these Social Security and Medicare benefits get paid out is clearly going to cause a financial crisis and a government funding crisis. But in spite of this, she still expected no new financial crisis in our lifetimes. She said this in 2017. Obviously, we get a new financial crisis every 5 or 10 years. And not more than 3 years after she said this, of course, we got a huge financial crisis when COVID hit and in response to the various governments' responses to COVID as well. So Janet Yellen, if she was running a hedge fund, it would have very, very bad returns. She's terrible at predicting these things. And I think there's a great tweet here from Joseph Wong, who used to work for the Fed. He was a trader for the Fed. He said the Fed is a business that can't fail, run by people who can't get fired. And I would include Janet Yellen as this in this category, even though she's no longer at the Fed. She's part of this revolving door of parasites and rent seekers who are also very, very bad at predicting the future. And she doesn't have to be good at this because there's no consequences from failure, as Joseph Wong says. He says, in my experience, competence literally has no value there at the Fed. The organization selects for obedience. Lifers like Janet Yellen, who's moved from the Fed to the Treasury and who knows, might move back to the Fed at some point, they tend to be very personable, but not very good at their jobs. So I think the conclusion from all of this is, if this is correct, and I think it is correct, you can trust Harald Malmgren. He's usually has his ear to the ground and is right on top of these things as they're happening. If this is Treasury's plan to push the Dixie up to 110, this is going to make for a very, very bleak summer. We can expect Bitcoin to continue to sell off. We can expect stocks to continue to sell off. We can also expect Treasuries to continue to sell off, at least into the point when the Fed is forced to reverse course because the financial crisis has gotten so severe. Maybe we're having credit events, or maybe we're having liquidity events where the markets freeze up, where the Treasury market, the liquidity gets so bad that the Fed has to step back in. I think this is the end game, but I think this probably is a plan that's going to take place. And there's a geopolitical angle to it, trying to jawbone oil prices lower. I don't think it's going to work, and I think it's going to end up further blowing up the stock market. So definitely something to keep an eye on. I'm not trading around my Bitcoin position, obviously. I'm holding on to it, but I think this is another way that Bitcoin gets down to 30,000, 25,000, or even as low as 20,000. If you found this video helpful, be sure to hit that subscribe and like button. Hit the notification bell if you want to be notified when I publish my next video. And let me know your questions and comments in the comment section below. Thanks a lot for watching, and I'll see you in the next video.